Thank you for joining us for the last market update before we take a break over the holiday period. I'm Sophia with Bell Direct, and today is Friday the 12th of December. Now, as the end of the year draws closer, let's review what analysts are expecting for 2026 and some key takeaways for your portfolio. The ASX 200 is reflecting a 5.39% increase year to date and is heading toward a third consecutive year of gains. The accumulated index, which looks at all cash dividends reinvested on the ex-dividend date, shows an increase close to 9%. Now, on the surface, that's a solid result. However, Australia has lagged behind many of its global peers. This is as a lack of heavy-hitting tech stocks and a sticky inflation problem has forced the Reserve Bank to hit the brakes on the economy longer than expected. Meanwhile, tariffs have impacted commodities trading with China. Now, heading into 2026, the biggest risk is valuation. The local index is currently trading at a price-to-earnings ratio of roughly 18 times, which is well above the long-term average of about 15 times. Therefore, Australian stocks are expensive right now. We're also seeing that financials have struggled, gaining less than 4% this year. Meanwhile, the materials sector has surged over 24%. And the trend may continue into 2026, shifting away from the banks and firmly into resources. The optimism for miners is driven by China. Now, despite trade wars and tariffs weighing on growth, there are signs of our largest trading partner finally exiting its deflationary spiral. If China stabilises, Australian economies look attractive, with analysts expecting the materials sector to be the strongest contender to outperform in 2026, picking up the slack where the banks and tech stocks have fallen short. As for the RBA, after cutting rates by 0.75% in 2025, the RBA is expected to hit the pause button for the first half of 2026. Now, inflation has crept back up, largely due to the persistent housing costs. The unemployment rate is forecast to tick up slightly to 4.4%. Economic growth is expected to stabilise around 2%. Now, looking at the market's performance this week so far, the ASX 200 has declined 0.31% this week, Monday to Thursday, with materials and financials in the lead, while technology and healthcare have weighed down on the market the most. On the ASX 200 leaderboard, battery minerals provider Liontown Resources advanced almost 19% this week. LTR recently executed a binding offtake agreement with CanMax Technologies, which will supply 150,000 wet metric tonnes of spodumene concentrate annually over 2027 and 2028. And auto equipment retailer Bapcor declined the most this week after the company reported it's heading for a bottom line loss in December, in the December half year, following the below par sales performance in October and November. As for the most traded stocks by Bell Direct clients this week, these were BHP and Pilbara Minerals. Clients also bought into CSL, WiseTech, Wagner's Holding Company and Phineas Corporation Holdings, while took profits from Fortescue, Westpac, ANZ and NAB. And the most traded ETFs were the Vanguard Australian Shares High Yield ETF, that's VHY, the Vanguard MSCI Index International Shares ETF VGS, and the Vanguard Australian Shares ETF VAS. And to end on economic news items to watch out for next week, on Tuesday, the S&P Global Manufacturing and Services Flash PMI will be out, a forward-looking estimate of the final PMI that's out the week after. This is an identifier for economic trends in the sector, and a reading above 50 will indicate an expansion from the month prior. Also on Tuesday, Westpac's consumer confidence data will be released, and on Thursday, consumer inflation expectations will be out. And that's all for this week. I'm Sophia with Bell Direct. Have a great day, and as always, happy trading.